Hey everyone, I just want to thank everybody for joining. I'm going to go through this slowly, give everybody some time to get logged in, but really quickly want to do some introductions. First, me, my name is Ryan Tagg. I'm with Dominion Payroll. I've been with the organization 8 years, and my role is to help with product-related questions or to point you in the right direction if I don't know the answer myself. Sometimes I don't know the answer, which is why Justin and Sue are here with 401 Go. There have been a number of changes that are state specific throughout the country. I think you correct me if I'm wrong, Justin and Sue, but 15 states right now have different state mandated retirement programs. Some of the newer ones, it looks like Utah, Minnesota, and then Virginia, where I'm based, and our Richmond office recently had a very large change that you should be aware of. But I'll start with Justin. Justin, why don't you go ahead and introduce yourself? He's from 401 Go.
Great. Let me just share my screen really quick. All right, awesome. Well, first off, I appreciate everybody taking some time out of your day to join us. Obviously these retirement mandates are impacting a lot of people, and there's a lot of uncertainty around there. So that's why you have myself. I'm a regional relationship manager here at 401 Go. So I kind of manage the relationship between us and Dominion Payroll. And then we also have the real expert on the call, Sue Hardy. She's our head of plant operations as well. But I really do appreciate everybody joining today. So what are we going to cover? We're going to cover first why the mandates actually exist and kind of how they work, the framework of them, because most of the states out there, they actually kind of follow the same path, although the requirements can be different from state to state. We're going to look at some of the common issues with the state IRA programs. We'll go through like a little quick scenario, and then we'll also contrast that with what the state plan is versus the 401k, kind of a side-by-side comparison, and then how Dominion and 401 Go as a partnership make it easy to actually offer this benefit to your employees. All right, Sue, over to you.
Yeah, so talking about why this matters, and I've been doing retirement plans for 25 plus years now, and it's interesting how much this has changed, especially over the last 10 years. We've seen a ton of change happening, and so much of this change is focusing on the participant experience. So why are states getting involved? And the reason is that we have 50 million Americans who don't have access to retirement benefits. And this small business are kind of the worst at it because it's just an extra hassle, it's an extra expense. It's something that they don't want to focus on when owners are trying to run a business. And so really just right around that 50% mark or even less of small business offer these types of plans to their workers, leaving just millions of employees without an option. What the research has shown is that employees are 15 times more likely to participate in retirement savings options if it's coming from payroll deduction, which is why these employer-based plans are so critical. And this is why, again, the states are getting involved and saying, hey, we want to make sure that employees are given the option. It's how expensive the cost of living is, and constantly changing and fluctuating. Employees need an option. They need to know where to go. So as Ryan introduced, what we have to do to stay compliant, to get involved as business owners, you need to understand what your state requires. So many states now, again, are getting involved in this game. And so really, most of these states, as they're mandating this, as they're making it a requirement, they're offering you an option. Those options, in fact, this is number 2 on our slide here. Those options are generally a Roth IRA type account that you're going to work with your payroll and have money deducted from a participant's paycheck and go into a Roth IRA. This then is competing with the 401k, number 1 on that bullet point list and 401ks have existed for a long time now, right? So you can offer a qualified plan like a 401k, or if you qualify, a 403b, something like that. Even simples would count in this qualified plan category. You can opt into the state mandated program, which is going to be that Roth IRA option, or you do nothing. And in that case, you're going to be subject to the penalties through your state where these laws are applicable. And so really, the first thing you need to do is make sure you understand what the requirements are in your state, and then come to a webinar like this to understand the options that are available to you.
Awesome. Great. Thank you for that, Sue. We'll be kind of going back and forth here, but how do the actual state IRA programs work? Typically, most of these programs, like I mentioned before, most of the states follow kind of the same framework. There are a couple states that are just a little bit different, but feel rest assured, the majority of the people on this call, they're all going to kind of operate the same way. One of the major things to take into consideration, and the employees are automatically enrolled. That's not just a requirement with the state RAN program. That's actually a new requirement with retirement plans in general. Everybody has to have they have to be automatically enrolled into the plan. So what does that mean? That just means the employee has to go in there and manually opt out. They actually have to give us a notice saying that they do not want to actually contribute into the plan. The program fees are paid by the employees. There's no employer contributions into it. The investment options are very, very limited on the state RAN plans. And really the participating employers take on the tasks. And this is really the big one that I really, really want to highlight on. That's what makes offering a 401k, a lot easier on the employer. Not only is it a much better benefit for the participating employees, but it's really going to take a lot of the administrative burden off of the business owner as well. Because whenever you offer these state RAN programs, you really take on a lot of the burden. You have to set up the account. You're responsible for making sure all the new employees are uploaded, terminated employees, et cetera. Like you take on all those administrative tasks. And so by offering a 401k, especially with our partnership with Dominion, with our integration, the API integration, we take over a lot of those administrative tasks for you. So it really makes your life a whole lot easier. And employers also get no tax benefits with this plan. One of the big things with Secure Act 2.0, and actually even the original Secure Act, is there are some very generous tax credits, which I believe we're going to cover, that the employers can actually take advantage of. And if you sit in a certain range, there's even a potential for it to offset your total administrative costs for the first 3 years. All right. So who is affected? We actually put this slide deck together right before July. So the thing is it actually just moved over to July, or just moved over on the actual employee counts that you need to consider, or the threshold that I'll call it. So it used to be 25 or more eligible employees. And if you are sitting in Virginia right now, and the only reason I'm highlighting Virginia is obviously Dominion's located in Virginia, and this is just going to be one example. And this is going to be able to highlight kind of how some of the other states work. But keep in mind, most states are different. Some are 5, some are 1, right? So in Virginia, how it used to work is it used to be 25 or more eligible employees, and they literally just moved it to 5. So if you are sitting in Virginia, you may have already gotten a notice in the past. You may already been aware of the 25 or more eligible employees threshold limit. But the thing is they kind of surprised everybody and took it down to 5. And it's in effect right now. You have to be in business for 2 or more years. And if you don't have a qualified plan in place, so as Sue said, if you do have a plan in place already, you don't have to worry about it. You're already in compliance. The only thing that you need to make sure that you do is down here on the bottom right-hand screen, you got to go and register online with the state so you can actually qualify your exemption. So there's a couple ways that you can do that. Most common way is just uploading a plan document. That's pretty easy. Keep in mind, if you're not in compliance right now, there are some penalties that they can hit you with. It's $200 per eligible employee per year. So keep that in mind as well. All right, on to you, Sue.
Awesome. And one other point on that slide Justin was just on that is important to remember is that even if you're exempt right now, maybe you haven't hit the 2-year mark as a business, or maybe you've been under 5 employees historically, the second you cross over those thresholds, you are responsible for getting things in place, and you're not going to have people pestering you and reminding you to do that. And suddenly you're going to get hit with a fine. So just make sure you're really aware of the rules again. But this next slide, I actually love this. This is kind of, we talked about the importance of educating yourself, knowing what options are available to you. And that's what this slide does for you. It kind of helps you understand the available options and what's available underneath each option. And so, of course, in our first column, we have that state mandated plans. Again, most of these are going to be Roth IRA plans. Your contribution limits, in all of your plan types, your contribution limits are going to be set annually by the IRS. And so these are for the current year. Your current year 2026 numbers for your state IRA is going to be $7,500 with a catch-up contribution of $1,100. Now, one thing I want to point out, if you look in the third column, we got this new plan type. This was part of Secure 2.0. This is meant to compete with these state plans. So this is an option for plan sponsors who have never had another qualified plan open. So if this is your first time starting a plan, you are eligible for the starter K. What I want to point out though, is that when this code was written, I think they meant to kind of compare it or keep it in line with the IRA rules, but they didn't write it that way. And so you'll notice that your contribution limits for 2026 for the starter Ks are actually the lowest amount across the board in your 3 plan types. For 2026, you're limited to $6,000 in those employee deferrals with a $1,100 catch up. Then, of course, down the center column here, we have our 401k plan, standard plan. We're going to have much higher limits, much more flexibility in this plan type across the board. So you can see right off the bat, we have deferral limits of $24,500 for the 2026 year. So significant increase over either the IRA or the starter K option. And then your catch-up contributions are really interesting. You're going to notice there's 2 numbers here. The standard catch-up for employees who are age 50 and above is that 8,000 number you see. But as part of Secure 2.0, they actually started implementing this super catch-up option. And that's for employees in the year that they turn 60 through the year they turn 63. So in those 3 years, you have the opportunity of really stocking away some extra money into this retirement plan. Other interesting things, I actually think this third row is one of the most important takeaways from this comparison chart, which is that employer contributions are only allowed in 401k plans. You cannot have employer monies go into your state IRA options or your starter K plans. So that's a really important takeaway, depending on as you're doing your planning, as you're looking at your tax strategies, if you even want the option of having a match or a profit sharing at some point, that 401k route's a really good route to look, just to give you the option. The other 2 plans, you don't even have the option. You can never add that feature to those other types of plans. Justin mentioned the tax credits. This is a really cool thing that came about with the first Secure Act we've had for a few years now. Employers really can take advantage of this. That's not available under your state mandate plans, but under both the 401k and your starter K plans, because those are both subject to those ERISA rules, you can claim and receive some tax credit back, really making your first few years, and we actually may touch this again, I feel like, but it makes your first few years of running a plan, your costs become very minimal when you look at the returns you're getting in these credits. So really important to know. One other interesting thing that is only for your 401k and your starter K is you do have those deferral options of doing either pre-tax or Roth. Again, this is more on that employee tax strategy, you know, what's the best long-term planning as an employee. In your state mandate plans, most of the time, these are strictly Roth, so they do not get the pre-tax option there. You can also set some eligibility provisions and other document-based provisions in your 401k and starter K. Again, not a possibility in your state mandate. And then investment options, much more diverse when you're setting up a qualified plan, which would be your 401k or starter K plan. Let's Next slide, Justin, if you don't mind. Thank you. So really, as I mentioned, what you want to look at when looking between these three options to know what the best fit is for you, you really have to look at what your goals are as a business, not just for this year, but what's your long-term goal? Because really we can help reduce your taxable income through some of these options, through having an employer contribution, through some of these tax credits you're getting, a qualified plan, and the state mandate too. Plans help you with employee retention. Employees view this as an attractive option. Sometimes it can actually help you get better candidates in the door, and really can just help build your credibility and your value as a company all the way around. So it really isn't about just avoiding those penalties from the state that you're now going to start seeing. It really can become a business tool and become a strategy to help you build a strong employee product and even company product that can help you just build and enhance the culture in your company. Next slide, if you will. Thank you. So here's just, we've mentioned this now a few times. So a few tips on the tax side of things, what to look for. And I guess this is, we usually say this at the beginning, but please, we're going to show some examples here in the upcoming slides. One thing, please do not take any of this as direct tax or financial advice from Justin or I. We are sharing some examples, and every company and every situation is different. So we just recommend that you take your own situation, your own numbers to your tax professionals and look at your options with them. Our purpose today is really to educate and help you know what options are available. So the first thing we mention is the opportunity and option of having employer contributions. Remember that anytime you put in an employer match, when you're matching somebody's deferral, or if you want to do just a general profit sharing or non-elective contribution to your employees, all of that is deductible on your income tax. So it lowers your net profits and becomes a tax savings for you, something you don't have to pay taxes on because you're putting it into a qualified plan. The second box here, of course, if you're in your first years of starting up a plan, there are these credits available to you, and they are pretty generous across the board. You can get up to $5,000 the first 3 years of your administration to cover the first 3 years of your administration costs, up to $1,000 per employee for the first 5 years, and then $500 for adding automatic enrollment. And it's funny that this one didn't go away with Secure 2.0. It hasn't, because Secure 2.0 mandated automatic enrollment. So everyone's automatically getting that 500 right off the bat. So really some pretty good savings your first 3 to 5 years of running this plan. Those are offsetting your costs. There will be administrative costs associated with running a plan. And so starting right now, when you have some credits, some offset, it's a great time to jump in and take advantage of this opportunity. And then one thing that we love to point out to business owners is that, of course, having those higher deferral limits as a business owner, this is personal tax planning, right? Again, underneath either the 401k or starter K, you have the starter K, you have those low limits. So it's less advantageous, but under a 401k plan, you have the opportunity to choose between that pre-tax or the Roth. And so really, as you're working on your tax strategy as an individual, you can utilize this tool and have that option and that flexibility of how to set up your own plan design to benefit your personal tax strategy as well. And again, I'm a huge fan of having the option available to participants, because everyone has a different mindset and financial strategy of what would work best for them. So next slide, Justin, please. And then this is my favorite thing, because I'm a huge compliance nerd and I love this stuff. I've been doing it a long time. So a few things to just keep in mind as you're navigating this process. First and foremost, and we have seen this in all of the regulation changes, is that participants need to make choices. You need to inform, you need to help educate the best you can. And that's why you have partners. That's why you have payroll partners. That's why you have, Dominion and 401go. Companies like ours are here to help you. And your job is to educate your employees. And so make sure that you're giving participants options. That's what all of these plans, that's what these tax mandates are requiring of you. We're seeing this more and more as with changes in the IRS and the Department of Labor, as they're having new regulations and things. It is very participant forward and participant focused. So your employees matter in this, and their own election matters in this. Record keeping of participant data is another really big thing, and particularly safe record keeping, making sure that you have secure options, because again, as we're offering this new benefit, it means we're dealing with participant private PPI, private personal information, that we as service providers and business owners need to help keep safe and protect our employees. And so having good partners, again, where you can have secure portals and secure ways to share participant information as you're doing these plans, really important to just check those security options. Cybersecurity, again, the Department of Labor has a great flyer on this. And I wouldn't be surprised, this is just Sue Hardy's guessing and opinion here, I wouldn't be surprised if we see them start litigating that a little bit more in the future and have some rules come up around the security of personal information. We stated this one already, but starter K plans are only available to companies that have not sponsored another qualified plan, that do not currently have a qualified plan. So if you currently have a simple IRA, you can't switch to a starter K. If you currently have a 401k, you can't switch to a starter K. They're only available for first-time qualified plan users. And then again, understand and know your options and the rules. As a business owner, you are a fiduciary. And even though you have a lot of companies that will help be co-fiduciaries, like 401go, we actually act as a 316 co-fiduciary for all of our clients. A lot of service providers offer that option these days. It will never fully take away the fiduciary responsibilities of you as a business owner, though. So really just important, again, get some good service providers, get a good payroll partner to help you understand what responsibilities you're in charge of and what you need to be aware of for the plan, and help keep you updated. I think this is a great timely webinar, especially for those of you in Virginia, because this just went into effect for you. The rules just changed for you. Good partners will help keep you educated as rules change and as we move forward in this. And Justin, back to you.
Yeah, well said, Sue. That is, I want to highlight that comment that you said about good partners will make sure that you're educated on that. The way that I've always seen these state mandates that as they roll out, and what I appreciate so much about Dominion as a partner of ours, is they're always willing to go out and educate their client base. And I don't necessarily see that elsewhere in the industry as much, but the way that I really view it is it's really my job to educate our payroll partners on when these mandates are coming down the line. And then, they should be able to help facilitate roll all that out to you guys. So we want to just give a couple examples. These are very, very generic examples of what's potentially possible in a 401k. And keep in mind, the same is not possible in a starter K or the state-ran IRA program. But if you look at, this is just going to be an example of a 45-year-old W-2 income of $400,000. This is, again, just using round numbers because you really need that income level to really probably maximize everything. But how do we get to that total of $72,000 contribution limit? Because, there's a couple different layers there. Even if you're the business owner, you can offer yourself a match, you do profit sharing. There's a lot of ways that you can get to that $72,000 limit. But the base of it on the left-hand side is that $24,500. And then you can layer on an additional $47,500 on top of that to get to the total $72,000. So we do have in here, current year tax savings that would save, especially on the business owner side, that would save them an estimated $26,640. Potentially even more if you actually do own the business, because you're going to have additional deductions for offering a retirement plan. But again, not tax advice. And then we'll kind of go to the next slide here. All right, so why is this a true tax benefit? So without a 401k, the owner pays tax on the full $400,000. With a 401k, that 72 grand is redirected into that tax deferred. Remember, there's two different ways to actually contribute into your 401k. You can either do what's called a Roth, So that means that you're taxed on the way in and you're not taxed on the way out, or you can do tax deferred, right? And so that's when you're not taxed on the way in, but you are taxed on the way out. So the business essentially lowers its taxable income and wealth compounds without that annual drag. And so if you look at that 72% annually at 7% growth over 10 years, keep in mind 7% is just kind of like an average historical number, but that could be all over the place. That would essentially, over 10 years, that'd be $995,000 in accumulated tax deferred benefit. Anything else you want to add on that, Sue?
Yeah, I mean, one thing I would just point out is that when we talk about the difference between the employee and employer contributions, remember that when we're looking at both personal tax strategy, but for the company, those funds that are going in as a match or a profit sharing are always tax deferred. They're always going in as a pre-tax option. And so really on the employee side is where we decide how we strategize that with the Roth or pre-tax. Interesting though, so that's why you always get a tax benefit as a business owner when you're doing that profit sharing or that match, right? That's always a deduction for you. Interesting enough, Secure Act changed this a little bit. They now have this Roth employer option. But as a business owner, one important thing to know about that feature, if you've done any reading or studying on that, we're not going to go into big details, but that tax portion, the taxable portion, it does fall on the participant and not the employer. So even if you were to offer the employer or Roth options in your plan, as a business owner, you're still getting the full tax deduction on the full amount that you're deferring or that you're putting in for a match or a profit sharing for your employees. And if you flip to the next slide, I'll actually take this next one. So this is truly a benefit for your company. Again, focusing on a 401k plan here, you have options of having some eligibility provision, meaning that you don't have to let everyone in the first day. You can put on there's some statutory requirements, but you can make people wait till they hit 1,000 hours before you let them in the plan. You know, if your turnover is really high in your first 3 months, put on a 6-month restriction or a 3-month restriction on your plan. Same with your vesting, and that applies to those employer contributions. You have great investment lineup options. You have those employer contribution options, and you have a flexibility on choosing your providers. Remember that under your state mandate, your flexibility is not going to be quite as much. You have a lot of control when you're dealing in a qualified plan. And there's a lot of options out there. And of course, as somebody who really supports fiduciaries making good, prudent decisions, I would highly recommend you look into your providers. And good providers are going to be very upfront about fees and things like that. So, and then you get your tax advantage, you get your credits, which are huge, especially as a first-time plan. You're going to get a lot of benefit from those tax credits coming in. And then really, again, looking at your staffing, looking at your employees, and that's who we care about, right? That's who the IRS and Department of Labor are really focusing on right now. Too, this gives you a lot of buying power with both hiring good hires and retention. Helps your employees have good financial stability in the future, reduces their stress levels, and it really can just enhance your culture as a company. We're getting close to time. I'll turn it back to Justin to.
Yeah, if I could actually jump in, we do have a couple quick questions. I just wanted to make sure before we got to time, we had that opportunity to answer those. Real quick, do all state mandated retirement plans require to file exemptions if
Yes.
they currently? Okay. You knew where I was going. Perfect. Well, simple answer. I'll move quickly. And then one more question. For purposes of tax credits, is the match separate from the safe harbor match?
Oh, this is a great question. So safe harbor, so all employer contributions, safe harbor is a type of plan, and it's a protected type. And what it protects is some of your required non-discrimination testing. You have to be fair in your plans, and safe harbor as a type is going to help protect you in some of that required testing. And so it applies safe harbor match or safe harbor non-elective. Or even there's another one called QACA, or Qualified Automatic Contribution Arrangement. That's a safe harbor option too. They all apply the same way any employer contribution would apply. So it absolutely does apply to your tax credits, and that type of plan does qualify.
Okay, great. And so just really quick, do all state mandated retirement plans require us to file an exemption if they offer an employer plan? The answer to that is yes. And then for the second one, for purposes of tax credits, is the match separate from the perfect answers there. Thank you. And sorry to cut you off. I'll let you finish up.
Yeah, no, thank you for that, Ryan. Awesome. Yeah, I'm gonna just fly through these last couple slides, and again, I appreciate everybody's time. I just want to highlight one thing about our partnership with Dominion Payroll is, we have a great partnership because you can really offer, you can really think of us as kind of intertwined together, right? So if you just look at some of the highlights here, like we can do same day setup. We have really great streamlined onboarding. We have the compliance, but really the biggest piece is really the strength of our API integration. Like I mentioned earlier in the call, that integration is really kind of mission critical to making sure that offering this 401k is going to be easy and seamless for you. So even if you do already have a plan and maybe you have experience administering a plan yourself and doing some of the more manual work, I can't tell you how much time this is going to free up for you. So you always keep that in mind. If your client, every client with us does get their own dedicated support representative. And one of the things that we always like to say is we automate everything but relationships. So whenever you have their number, you're actually calling them directly. They're not just reading through notes. And then even for the participant side, if they have to call into our general support, they're actually talking to a real human being, and there's not a phone tree there. And as you can see, we just got some stats down at the bottom. 98% one-touch resolution, which is great. You don't really see that across the industry. Our uptime is almost 100%. Client retention is at 95. So those are just some nerdy numbers just to kind of show you the strength of our company. But if you go online and go to G2 and all that stuff, you'll see us compared to some of the other companies out there. And one thing that you'll see with us is we don't have any one-star reviews, and most people are raving about our customer service. All right. So quick thank you. I'll leave this up on the screen for as long as you want it here. But if anyone needs anything or has any questions, you can always reach out to me or just reach out to your Dominion contact directly, and they'll get you in touch with us so we can help you out.
Yeah, perfect. Justin, Sue, thank you so much. And just touching on Dominion and how we can help. Look, I'm a big believer it never hurts to evaluate. So if you want to evaluate, like if you have a current plan, but you want to evaluate alternatives, I think it makes a lot of sense to look at 401go, particularly if you are currently a Dominion Payroll client. But also keep in mind, we administer third-party plans as well. Right. So whatever works best for you, we just want you to be happy and have options and feel supported. So if you're having difficulty remitting payments or managing the deductions in the payroll system, we have solutions to help. And, oftentimes they're very inexpensive, especially with administrative fees. And I think Justin and Sue did an excellent job highlighting the fact that some of these tax credits, but really, if not completely eliminate, diminish any tax obligations you have if you don't currently have a plan. So it really does make sense. Anyway, Justin, Sue, thank you again so much. To echo what Justin said, please feel free to reach out to myself, or if you have contact information with your account representative here at Dominion Payroll. We're all familiar with the different options we have as it relates to retirement plans. So thank you all so much for your questions and for your participation. And I look forward to connecting with everyone else again. I hope everybody had a great 4th of July. Thank you.
Thank you, everyone. Have a great day.
Bye, guys.